Hi, I'm Tim Quast, founder and CEO of Market Structure Edge, and we're going to cover a lot of ground over the next 30 days, but I know that what you really want to know is, Tim, just tell me, what should I be looking at when I trade stocks? Well, we talk about three things: broad sentiment, B; context, what's the calendar and cadence of the market; and divergence, a separation between supply and demand. And I'm going to show you, we're kind of jumping ahead because we'll talk about this some more, but I want to cut straight to the chase of what matters to you as a trader. So let's look at Apple. I've set up a custom range here of June 30 to October 11 because it gives a great illustration of this concept of divergence. Demand rising, supply falling or staying the same. That is a divergence. Let's just look here. You can see right here, this green part of the graph, it's an algorithm that meters demand, buying and selling, from investors and traders. And when there's more buying than selling, it goes up and rises above 5. It's a 10-point scale, and it can hit 10. And look, this is Apple's price. Apple's price rose the whole time that there is excess demand. On the other side is supply. It's short volume, not short interest. Short volume is the percentage of trading volume from borrowed stock. It's a great gauge of supply. Supply trended down. Demand rose. That is divergence. And if you just use that, you'd capture all the gains. Look what's happened since. Apple has not since been back above 5, and the price has fallen. Well, you can avoid all that. This is the core distinction between Edge and everything else. We're the only platform that shows you how to trade supply and demand, and it's very effective. And now you've had a look. We'll cover a lot more. Stay with us.